Alright guys, the YouTube stream is up. General chat, I posted the link so you can join it and follow along on what I'm doing, ask questions, all that good stuff. I'll give it a few more minutes though. I had a lot of people sign up. Only about 8 in here so far, 9 people, so I want to give it a little bit more time. Either way, I'll also share the link because YouTube records it for me, so anybody that doesn't make it or has to leave early or whatever the case, you'll be able to watch the whole thing if you'd like. I'll give it just a couple more minutes. Some people may have forgot, so maybe they'll see. Jackson, I see you in here. Does it show you where it adds everybody, or is there somewhere that it's supposed to do that? Oh, okay. This is my first time here doing this, so I'm not sure how it works on this server. So kind of winging it at first, but we'll get it right. All right, I'm probably going to go ahead and get started. So this is essentially, we're going to talk about fundamentals, or how to look at stock fundamentals to determine whether or not you want to invest into something, right? So essentially we're going to go over these 10 specific types of things, and I won't draw it out too long. I'll try and be as quick as I can. I know that some people can get glazy-eyed sometimes, so if you want to take a quick read here and see what we're going to be talking about, and then I'll start, but I'll go ahead and speak it out as well. So we're going to analyze, look at some tools to analyze fundamentals, earnings and intrinsic value, income and debt to equity ratio, company's value, PE and PEG ratios, market cap, short-term outlook, peer evaluation in the industry, economic, industrial, and company factors. Right, so all of these things are going to be pretty important. Now, obviously, with fundamentals, there's just so many things that you can look at in terms of fundamentals. So this is kind of what I think is somewhat the important stuff, but again, everybody has their own opinion, right? So we're going to move on to the tools that I personally think are pretty good to utilize when you're analyzing fundamentals. And on the slide, I basically, essentially, there are many ways that you can educate yourself with fundamentals of a company, right? So there's a lot of free stuff out there. Free things are usually limited. If you're going to pay for something, then you're definitely going to get a lot more than you would with something for free, right? So like FinViz, there's a free version. Motley Fool, there's a free version, but you don't get a lot, right? And I'm going to share FinViz so you guys can kind of see, where is it? So with FinViz, and I've got Tesla up, So when you pull up Tesla on FinViz, obviously it gives you the chart. You can look at intraday, daily, weekly, monthly. You can draw stuff or whatever. It's not bad for an analysis type of tool. And when it comes to fundamentals, it's got a bunch of good information down here. My index, market cap, income, sales, all this good stuff, right? Earnings per share this year, this quarter, etc. Even has short ratios and float. There's just a lot of stuff here you can utilize. I personally think with all the free stuff, FinViz is probably one of the better ones simply because it has all of this information in one spot, right? If I go to Motley Fool is more like news. All right, so if I go down here and look at Motley Fool, you've got a bunch of news here that's specific to Tesla, right? Which is basically what I pulled up here. But it doesn't have too much in terms of like FinViz, right? This is more specific and granular versus Motley Fool is more article based. Now there's more in here that you can do. It's got market moves, podcasts, earnings, stuff like that. But for the most part, it's an article based website. You also have a company called Chartmill. Chartmill is pretty good, I think, as well. It gives you quite a bit of similar stuff that FinViz does, right? I think this one's somewhat limited as well, more so than FinViz. But essentially all of these are going to want you to sign up. So I've had an experience of looking into something that you pay for, and I think CoiFin is probably going to be the top one, right? So I've got an account here that's it's a paid account, and it has so many things in here that it's just, it's going to take a lot of time to sift through. So this one is kind of like an application almost, right? There's just so much in here that you can use to do a fundamental analysis on a particular stock, right? This is absolutely one of the better ones in my opinion. So let's pull up Tesla real quick. You can even draw charts. You can draw moving averages. This is definitely, I think it's somewhat worth it. It's not very expensive. I think it's like $15 a month. Honestly, not sure now that I'm saying that. I think it's around that. It's been a while. I've got on like a renewal thing, and I probably should stop using it or stop paying for it because I haven't been using it. So that'd be a good thing to save a little bit of money. All right. So with that being said, we're going to move on. So earnings and intrinsic value. Now, if any of you folks have questions, feel free to ask on the YouTube channel or in general chat. Just at me there so that I can see your questions. So earnings, intrinsic value. Earnings obviously is going to be history and future to help predict the direction or the potential direction of the company, right? Future outlook can be measured in multiple ways, and intrinsic value is going to kind of help you determine what the future value may reflect, assuming there's not things like COVID or war or something like that, which is going to inadvertently affect pretty much everything. But basically, intrinsic value is going to reflect the true value of the stock, something that's more realistic. And it's going to basically tell you whether or not it's over or undervalued. And I'll kind of go into detail with that a little bit later because there's a particular way that I personally like to determine intrinsic value. I will talk about it real quickly though. Intrinsic value, basically, to determine or calculate that, it's estimating the company's future cash flow, calculating the present value of each of the future cash flows, and then you sum it all up to present the values, and that obtains the intrinsic value. And later on, I'm going to discuss the PE ratio and the PEG ratio, and those are very similar to intrinsic value. So typically, if I'm looking for intrinsic value, I'll look at the PE and the PEG ratio, and I'll go over that a little bit later in this slideshow. Another way to measure or measure fundamentals is earnings per share, right? And this basically helps you understand how much a company's making per share divided by the number of shares that it has that are outstanding. A pretty simple way to determine. I use Thinkorswim when I'm trading, and there's a way to show. I'm going to pull up Thinkorswim right now just to show you guys. There's a way to look at earnings per share very easily on Thinkorswim. Essentially, it puts it on the chart for you. When you look for a particular stock, you'll be able to just look at the earnings per share right off the bat when you pull up the chart. So I'm going to pull that up here real quick. Thinkorswim is loading, so bear with me. While that loads, I will say that when we look at complex trading like options or futures, in-blood volatility is going to be something that affects that, and the fundamentals and earnings per share and the PE and PEG ratios, none of that stuff matters when we talk about more complex trading like options or futures or Forex or whatever the case. So I'm not going to go into that, but I just wanted to kind of make note of that. So let's see here. I'm going to pull up Tesla. Just get this. Okay, there we go. And I always use Tesla just because they typically have a lot of stuff happening. So I gotta remember how to pull it up. I forgot to do this earlier. I could have saved some time. Equities. Well, I'm not going to spend any time on it. Forget it. But you can do it. And it'll pull up. It'll kind of show it down here at the bottom. And you'll be able to just kind of hover over it and see the earnings. I can actually probably do this as well. Like, see here, Starbucks. If it'll wake up. Normally I can hover here and it'll, oh, here it is at the top. I don't know why it populated up here, but it shows the dividends, earnings, and when the conference call is. This is upcoming. Typically, if something had earnings, it'll, I don't know what the icon will be, but it won't be a question mark. Okay, moving on. Income and debt to equity ratio. Now this is going to be, oh, I see, let me just pause for a second. I see a question on YouTube. My thoughts on Yahoo Finance for data or even looking at the P ratio. Yeah, Yahoo Finance is pretty decent. That's another fairly good one. It's, let me pull it up. This one is pretty decent, I would say. Again, this is going to be one of those, it's got articles, it's got some other things that you can do in terms of looking up P ratios and that kind of thing. It's a pretty good tool as well. It kind of it's like a combination of Motley Fool and FinViz in a way. It's going to show you some fundamentals, historical data, obviously statistics. It's also going to show you a handful of articles. And, they always have these recommended trends and things like that, but, honestly, I don't necessarily follow those because this is just like another analyst that's giving their opinion. And, there's so many stocks out there. How's one analyst going to have all these opinions for all these other stocks? So take it with a grain of salt. But yeah, definitely, I would say Yahoo Finance is another solid one. All right. Joker, I'll get to random questions after the slideshow, but I'll be happy to answer that. So let me just stay on topic, and then I'm certainly happy to answer any questions that after the slideshow that are separate from this. Okay, so income and debt equity ratio. This one is also somewhat important, I think. We're going to be looking at. I'm trying to how to explain this. So, the ability of the company, right, to cover how much debt and how much profit or money they have, right? So, let's say a company is doing really well right now. They've got a lot of money. Their liabilities, or basically things that they're servicing debt with, right? So, like, let's say Tesla. I'll use Tesla because they're pretty easy to use in situations like this. They've got a lot of money, but they're also investing in a lot of new technology, right? So like their new batteries, the 4680 cells that they've come out with, and Battery Day a couple of years back, they discussed what they were going to invest in terms of their new manufacturing future. That is what I would call a liability. And how much income or profit or money do they have in case that goes belly flop, right? If that belly flops, then do they have enough money to cover that loss to keep the stock afloat? That's going to be your debt to equity ratio, or income and debt to equity ratio, right? So income statements, balance sheets, and cash flow, that's going to give you your income. And then your debt to equity ratio is going to basically determine, okay, how much debt and liability do they have compared to their equity? And is the number of, when you look at ratios, is the equity side of the ratio higher than the debt? If it is, then that's a somewhat safe investment. Now, it's not to say that if the debt is higher than equity, it's a bad investment. It just means that it's more risky, right? So, going back to income statements, it involves revenue, gross profit, operating income. The expenses are going to essentially be how much out of that income and that revenue and profits is it going to take? And, when you calculate all that, it becomes your net profit and or net loss if the company's not doing so well. So balance sheets is another way to kind of analyze assets and liabilities. Assets are going to tell you how much you're making or what the profit values are, and then the liabilities are going to say, all right, out of my profit, how much money do I have to spend to cover my liabilities? And obviously those two combined, you're going to determine whether you're net positive or negative in income. Cash flow is essentially income. After everything's said and done, this is going to be the money that they can use to invest or finance new stuff to grow and expand their business. So cash flow is a really big and important thing. Apple, as an example, has huge cash flow, so they're able to invest in new things. Like they wanted to basically be a market competitor with Tesla on self-driving cars. I know they've talked about that in the past. Where they stand on it today, I don't know. I haven't really looked into it. I think Tesla's kind of leading the way, and there's a couple of Chinese stocks out there, or EV manufacturers, that are kind of trying to do the same thing. So there's some competition, which is always good for the market. All right, moving on. Company value. Now this is kind of a generalized thing, but it's still good to know. It's still good to kind of pay attention to. You know, when you think of a company and their face value, at least me, I consider their brand and management decisions, their products, and or their services, right? So, excuse me. Those are all important things to understand, because you know, the direction of the company is based off of some of those things, right? Their products, are they good quality products and services? Are they good in quality? Is their management making sound decision making to, you know, better the direction of the company? And of course, their brand in general. Is the brand popular? Is it in style, right? You know, does it stand out among the competition? You know, I'll use an example like Nike, right? So when we talk about Nike and apparel and shoes, let's specifically discuss shoes, right? So when we talk about Nike, does Nike stand out amongst its competition? Like, you know, when you put a pair of Nike shoes with Adidas and Reebok, Skechers, Puma, whatever the case, does Nike catch your eye first? I think it catches my eye first. I've always been a big fan of Nike. I've always liked Nike shoes. They always get the really, really top-notch athletes to do their marketing. You know, one of their best ones was Michael Jordan, right? So they even created an offshoot of Jordan apparel. It's still owned by Nike, I believe, but you know, Michael Jordan's line of clothing is certainly in style. You know, when people talk about getting Jordans, I mean, they clamor over it. I've seen guys, when I used to work at the Finish Line a long time ago when I was younger, guys would come in there and get the whole entire gear, you know, Jordan shoes, socks, boxers, shorts, shirts, headbands. I mean, they'd be Jordan from head to toe. And Nike is definitely taking advantage of that. So, you know, when we talk about companies' brand and face value, you know, the image is huge. So if the company's got solid image, they're most likely going to be a good company to invest in. Now, in terms of growth, if it's a company that's been out there a long time like Nike, there's a chance that they're not going to grow as much as they did in the past, right? So when you're looking for growth, you're going to try, you probably want to find companies that are kind of new, right, and trying to establish themselves, whereas, you know, Nike's going to be more static. It's going to be one of those that you're going to, you know, play. If you're going to get into Nike, it's not going to move as much. You're going to probably want to do shares. You're going to want to do long-term investments on it. Get it when it's a 52-week low or a 3 or 5 year low. Good to get into something like that and sit on it for 5 years or something, or however long. So, you know, that's kind of how I would suggest investing in companies like Nike. Now, I'm not necessarily going to say, hey guys, you should go invest in Nike, but I definitely would say if you are looking to invest long term, Nike's a good option or choice, right? Okay, let's see. Next one, PE ratio. Now, we're going to kind of go back to intrinsic value here with PE ratio, because the two are almost the same. They're not exactly, but they're very, very close. I'd call them brothers. And PEG ratio is going to be after this, and I'll show you guys what that's about. But the PE ratio is obviously the one of the most common types of fundamental analysis. And it stands for price to earnings ratio. Right, so again, it determines if it's over or undervalued, right? And remember, intrinsic value does the same thing. And it measures the price, you know, relative to the earnings per share. Now it's relative in a lot of cases. It's not always exact, but it does take in some calculations that can generally give you a good foundation and understanding of where it sits based off of its over or undervalued position, right? So generally speaking, a higher PE ratio means that investors have an expectation of higher returns. So this is going to make it more risky. When you use PE ratio, you're not necessarily looking, again, it does measure if it's over or undervalued, but if you want to get specifics on that, you got to look at intrinsic value. But if you want to get a generalization of it, the PE ratio does the job. Right? Now, PE ratio, the reason I say it's generalized because it just says that the company's higher risk if the PE ratio is higher, and it's lower risk if the PE ratio is lower. So like Nike, for example, would be, I'm pretty sure it's a low PE ratio, whereas Tesla is going to be a much higher PE ratio. So, you know, take it for what it is. Risk is really the name of the game when it comes to fundamental analysis and long-term investment. When you do fundamentals, you're essentially looking to do more longer-term investments, 1, 2, 3, 4, 5 years minimum, something around those lines. You know, if you're looking to do something that's daily, weekly, monthly, or quarterly, you know, like daily is going to be options and futures. Weekly is going to be kind of the same thing. Monthly, you can kind of get away with doing shares. Quarterly, it's definitely going to be shares. You know, stuff like that. Thanos, you can make 100% in 3 minutes by getting really lucky and investing in something that takes off right after you get into it. It can happen, but again, when we talk about risk, that's risk. Very risky. All right, now the PEG ratio. Now this one is also really good. Really good to determine the future of the company, right? So the PEG ratio helps you look at the future outlook of the company's growth based on a specific time period from a quote-unquote forward-looking perspective. So you're essentially speculating the future growth of the company. Anything below 1 on the PEG ratio is generally undervalued, whereas something above a 1 is overvalued. So, you know, if something is undervalued, then the chances of having a lot of good growth is higher. If it's overvalued, then there's a chance that it's going to come back down in value before it starts to move back up again. The probabilities are usually situational there. But I can't say for certain that it's always going to happen in that manner, because chances are, you know, we're just at best speculating. But the calculation of this ratio is the PE ratio divided by the growth rate earnings of a particular time frame, and you can do this based off of a certain time frame that you particularly are interested in. You can do 1 year, 2 years, or however many years that you want to do investments in. You can, you know, calculate the PEG ratio and determine if you think in that time frame that you're looking to invest fits that model. All right, moving on. Market cap. Now this one is more, I would say, even more so generalized. And when you look at market cap, you're basically looking for growth stocks or blue chip stocks, right? So market cap is how much the value of a company is based on how many shares it has outstanding. They usually sort market caps based off of micros, small caps, mid, large, and megas, right? I'll just kind of quickly and briefly show you. 1 second. I'm going to have to pull this back up every time I want to do it. So, this particular stock, ADMA, is going to be a micro cap. Right, and we're looking at, $2.34 today. So anything under $10, in my opinion, is a penny stock. But that's just my opinion. All right, so let's see. And that was a micro cap, so basically 50 million to 300 million. AAC. Let's see. Now you see this one's nearly triple the price of that previous one. So Ares acquisition, I'm not going to necessarily go through and explain what all these are. I'm just going to give you guys an example of what the name of the stock is and how much it's currently valued at in the market. So $9.87. That one is a small cap, so 300 to 2 billion, probably a lot closer to 300 million. BCO, we're looking at, this is a $60 company, Brinks. So everybody knows Brinks. But this is a $60 company, and this one is going to be valued mid cap, 2 billion to 10 billion. Large cap, American Airlines. Now, the stock prices don't always reflect whether or not they're mid caps or large caps or whatever. As you can see, this one's a lot lower in value based on versus Brinks. But American Airlines is obviously they're when you talk about market cap, you essentially add in all the assets and things that they have. So like when you talk about Brinks, their main thing is picking up money and bringing it to the bank, that kind of thing. And a lot of their investments are the trucks that the employees drive. When you talk about American Airlines, the investments are airplanes. So one airplane is probably worth the whole entire fleet of Brinks trucks. So consider that. And lastly, Apple. We all know Apple is huge. It's $1 trillion market cap, honestly. So, 200 billion or higher. 200 billion or higher. Apple is definitely falls within that category. So, when you're looking for investing in a company based off of growth or stagnation or blue chips or whatever the case, you can generally start in a specific market cap. All right, so if you want growth, you'd probably go for micro, small, or mid caps. If you want stagnation, you'd probably look at large caps or mega caps. But blue chips are going to be more in the mega cap section. So that's just another little caveat that, if you're going to do fundamental analysis, that could be a way to help you start doing that. A good area to pinpoint, based off of market cap. So short-term outlook. I always say this is very subjective, highly subjective. But for me, it's 2 to 4 years. Long-term is 10 years, 8 to 10 years. Warren Buffett is a long-term investor. He does 10-year time frames because he knows within, this year, next year, the market could go wild and crazy, but he knows over the long period of time, 8 to 10 years, it's going to be worth more than it was today. And this is, I don't want to say 100% true because I'm sure there's something out there that's obviously going to prove me wrong, but I would say more so than not, the probabilities are going to be in that favor. But based off of companies' events and earnings, if they have something new coming out, expected revenue can increase. And that's there's a lot of speculation that goes on when a company has something new coming out because most people invest in hype. They don't necessarily invest in the actual outlook, right? So, and I'll go back to Tesla as an example. When I saw Tesla Battery Day, I guess it was 2 years ago. I thought it was a really good investment opportunity for a long-term position, because the stock, when they start talking about manufacturing and bringing all of these things they outsource in-house, that's a money savings position. They're gonna certainly benefit themselves from owning all of the production and the manufacturing. So they're doing their in-house battery cell production, the 4680s. They also have Panasonic doing some for them as well, because they just can't, Tesla can't make enough batteries for their cars. But ultimately, their goal is, I would imagine, to produce the most in-house, and then whatever extra they need, they'll get from Panasonic. So that's an example of, doing a company investing in their future and you wanting to invest in their future. So going back to Battery Day, when I watched Battery Day, I thought, wow, what they're talking about is really great. It's innovative. It cuts on costs. It even helps ecologically. There's a lot of benefits to it. But the day after Battery Day, the stock dropped, I want to say it was 20%. So very, very short term, fundamental analysis is kind of garbage, honestly, because you really can't invest in a stock when you're trying to do short term stuff like that. But if you're looking 2 to 4 years minimum out, then I'd say investing on a company because of news like that, or company events, that's going to be probably a good thing. So enough about short-term outlook. And like I said, I got these slides up here so you guys can kind of read over what I've typed out. I'm kind of just winging it and going off the top of my head when I'm talking here, so I'm not necessarily reading from these, but this is just some good information that I thought would be beneficial to you all here to read. So peer evaluation. Peer evaluation, I put news in here because I think that's part of the evaluation of its peers, right? The media, quote unquote, is a peer. And they're going to evaluate whether or not it's good or bad. They're going to make an evaluation on a company. And that increases volatility. So, when certain news comes out, or when they talk about a company in the news, it's going to increase volatility because it puts it on people's radar, and that increases the stock price, or rather the amount that the stock is traded is increased. Whether or not it's up or down, that's irrelevant. It just increases the flow of the trading. Or I would say liquidity is probably the best way to describe that. It increases liquidity. Now, bad news that I would call a black swan is going to be like COVID, or like this year with the whole war in Ukraine. That's a black swan, and it's pretty rare that we have two black swans, back to back, essentially. I mean, within 2 years, I would call that back to back. But those are black swans, and COVID was an instant black swan where everything just tanked, and Ukraine has been a slow and steady melting of the stock market. So it's like an hourglass. It was full on the top, and it's been draining since. So at some point, though, we'll get a bounce. I can't tell you when, but there's a chance that we will see a bounce within the next year or so. I mean, the moment they announce that Russia either decides to pull back or they come to some kind of peace agreement or something, you can guarantee stocks are going to have a good day on that day. And if it stays steady, it's going to continue forward. Inflation's another one of those things with news where, inflation being bad is bad for the market. Everything costs more. Then we start talking about when they're increasing rates. So, as an example, when the United States increases its rates, its products overseas become more expensive, but the products that we import become less expensive. Now, you wouldn't notice that right now because of inflation, but generally speaking, if there was no inflation and our rates increased, interest rates increased, you'd see products most likely going down in value for us because our dollar has gotten stronger. For those of you that are in the U.S., that is. So that's just a handful of things or examples that I wanted to use. Trying to think of something else, but I'll just sit here and probably go off on the deep end, so I'm going to move on. Economic, industrial, and company factors. Again, very important things to analyze when you're doing fundamentals. Now, I know this seems like a lot, but if you're looking to invest in a company for, a minimum of two or 3 years, you're going to want all this information. You're going to need to really research and do a report on every single ticker symbol that you find interesting or that you think is worth a good investment. So external company factors the way that we measure those in some ways is going to be the performance of a particular company or the industry. It doesn't necessarily even mean the company itself. So I've got here the airline industry during COVID. That's COVID was an external factor, and it affected the airline industry very negatively. So that's one thing to look at is external factors are going to be probably immediate driver of impact on the price of the stock. Let me just pause for a second here. I'm going to close my computer room because my child's screaming and I don't know if you guys can hear it. All right. And again, external factors, Ukraine war, huge external factor. If Iran decides to create some problems in the Strait of Hormuz, external factor for oil or shipping. Typically, it's mostly oil that goes through there. So those are a handful of external factors that you got to kind of take into account. Internal factors, we're thinking of, things like leadership. How good is their leadership? If it's solid leadership, then that's a positive internal company factor, right? Goals, teamwork, direction, strategy, communication, partnerships. Those all lead to success. The vision of the company, solutions to problems, what types of partnerships they have with other companies or the government or other countries, based off of, do they manufacture in a different country? Is the partnership with that country on solid footing? Those are important things to know, because if it's not, it's going to affect the company negatively, and there's not a lot that they can do about it. With if their partnership's a huge deal in bringing success to the company, it's going to be really hard for that company to do solid, consistent business. All right, so those are going to be very important. Now, when you invest in a company like Facebook, for example, you want to factor in how relevant the company is based on the future of the world and the growth of the company. Now, with Facebook, they changed their name to Meta, and they're trying to get into the metaverse. They have virtual reality headsets that they want to start trying to kind of get their feet wet in that arena. I don't know if anybody has seen a movie called Ready Player One, but that is probably the greatest example of the metaverse and virtual reality. And I believe the future is going to probably be something along those lines. So if you haven't watched that movie, you should check it out. But Meta has shifted into the VR space and metaverse, and they obviously have a big solid position in social media, but they recognize that crypto and the metaverse is something that's going to be a future thing. So they're shifting some of their business into that direction so that they can better position themselves now while it's not huge, right? They want to be one of the leading drivers in making it huge, because if they can, because they're already a big company in social media, it'll be easy for people just to go and start doing metaverse with Meta. So that's one example that I was going to give based off of company factors and whether or not they are investing properly in whatever arena they're investing in, right? So that's the end of it. I'm going to stop the video now, but I will continue to stick around, and if anybody has any questions, please do message me in the general chat, and I'll be happy to answer whatever you've got.